Thanks for clicking. The Bank of Canada has released its financial stability report and is warning of a major increase in mortgage payments over the next few years, but is also noting that even more stress as of right now is being borne by renters.
Who?
Indeed, as we'll see today, although the bank is warning that over the next 2 years, those renewing their mortgages could see their payments increase by as much as 60%, right now it's renters, non-mortgage holders, that are showing the most signs of financial strain. And this point was stressed by Bank of Canada Governor Tiff Macklem and Deputy Governor Carolyn Rogers at the press conference held shortly after the report's release, where, despite being warned not to ask about interest rate cuts, Canada's Titans of Journalistic Integrity asked the governor 3 times about interest rate cuts.
Focused on our path of interest rates, and we'll have more to say that on June 5th.
I hate this
That brings the total number of rate cut questions this year across 4 press conferences to 16.
Okay, past inspection. All right.
So what I want to do today is go over the financial stability report, take a look at the press conference and what the bank had to say about its worries going forward, both for renters and mortgage holders, and then discuss some implications. As we'll see today, inflation continues to be at the forefront of the thinking of the central bank, and we're waiting for April's inflation data coming out on the 21st. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. As mentioned, the Bank of Canada's Financial Stability Report went over some of the signs of financial stress being borne by Canadians, but noted that the majority of that stress, right now at least, is being borne by non-mortgage holders, meaning primarily renters. The report showed that delinquencies on auto loans, late payments on auto loans, are almost 7 times higher for non-mortgage holders than for those that have a mortgage, and credit card delinquencies are almost twice as high as well. Which makes a lot of sense. Renters have seen a lot of inflation over the past few years. They've seen their cost of living go up and don't have the equity available to pay off those loans at a lower rate.
I've got a solution.
Yeah, credit card loans don't float, don't change with prime, and auto loans are based in large part off the bond market, so they don't fluctuate with the Bank of Canada's rate. Inflation, the cost of goods, is the real concern for renters. And Governor Macklem acknowledged this at the press conference.
The segment of the household population that is having more difficulty are renters. I think, renters tend to have lower incomes to start with, so they've got lower buffers. They've been particularly hard hit by inflation, food inflation, rent inflation, as well as high interest rates. You're seeing more indicators of stress there. That is certainly something that we need to keep an eye on.
With that said, we are still seeing some signs of stress for those who do have a mortgage, with the share of mortgage holders that have a credit card balance over 80% of their limit increasing over the past year. And the increased reliance on credit cards on behalf of mortgage holders is of particular concern, especially considering the number of mortgage renewals coming up over the next 2 years, with 2025 renewals expected to see a 25% increase in payments, and 2026 renewals expected to see a 31% increase in mortgage payments. Further, the numbers are even more concerning when we look at the renewals for those with variable rate mortgages but fixed payments, which the bank estimates will see a 60% increase in their mortgage payments. And we've talked about this at great length on this channel, via the multiple reports of 60, 70, even 90-year mortgages, where the borrowers are only making interest payments, and then, come renewal, their amortization snaps back to the original, sending their mortgage payments skyrocketing upward.
If you like our work, tell your friends, okay?
Given that, according to the Bank of Canada, 8% of Canadians, not just 8% of homeowners, but 8% of all Canadians, have a variable rate mortgage with fixed payments, this is definitely a concerning number. And Governor Macklem addressed this at the press conference, noting that, despite the opinion of some industries of you-know-who, current success is not a predictor of future success.
But, even if it's been going reasonably well, and even if we think the base case is most households will have the financial flexibility to deal with that, even if it's not easy, there are risks. And certainly if the economy was to slow much more sharply than we have into our base case, if more Canadians lose their jobs, the unemployment rate goes up, all of a sudden that stress, that vulnerability is really a risk of crystallizing. More households won't be in a position to pay that mortgage, particularly given the larger reset. So it is a vulnerability, and the point here is households, banks need to get ahead of that. We know it's coming.
So, mortgage delinquencies are holding. Everything appears to be holding, though the Bank of Canada is concerned about the ability of Canadians, mortgage holders and not, to continue to meet their obligations if the economy takes a turn. And the bank is warning about that potential turn.
You're f***ing warned, don't ever...
So, the bank is noting that it's seeing a major uptick in signs of financial stress among non-mortgage holders, primarily renters, but sees potential more stress coming from mortgage holders in 2025 and 2026, when all of those buyers who took 5-year fixed rates during the pandemic and those buyers that took variable rates with fixed payments come up for renewal. And given the debt loads of Canadians and the potential stress on the mortgage market coming in 2025 and 2026, the governor was asked a lot about rate cuts, even though reporters were specifically asked not to.
And I'll remind you respectfully that the topic of the day is the Financial Stability Report. Our next scheduled press conference for monetary policy is less than 4 weeks away.
And no, they didn't listen.
Does your forecast and outlook incorporate a reduction in borrowing costs, i.e. interest rates? Is that...
The governor didn't answer, as he was never going to answer, but this didn't stop this guy from doubling down, engaging in a lopsided battle of wits.
What is your opinion about market expectations for the path of interest rates right now? Do you think they're too timid, too aggressive?
To which the governor politely responded,
We're really focused on our path of interest rates, and we'll have more to say that on June 5th.
That's it.
And very briefly, one more time, the next rate cut question came from Global News.
What overall does this financial stability report tell you about the need for interest rate relief right now in Canada, particularly for those renting Canadians?
For his part, the governor reiterated what he had just said 1 minute prior and noted that the stresses being faced by renters were all the more reason for the bank to get inflation under control.
The reason why it's so important to get inflation down is so that households don't need to worry about big increases in their cost of living going forward.
So, the Bank of Canada took a much broader view of the Canadian economy at this press conference and in the Financial Stability Report, pouring some water on the notion that the central bank is only here to support the real estate industry.
I want to drive a Range Rover.
And I think this report and this press conference highlights what we've talked about before on this channel, that, in essence, this is really a tale of two Canadas. Renters, non-mortgage holders, those who, for whatever reason, were not in a position to take advantage of the 2020-2021 free money-fueled housing boom.
It was me.
No, it wasn't. Those who were not at the right place at the right time and were not in a position to take advantage of the increased equity in their home still got the inflation, still got the cost of living crisis, but didn't really get any of the benefits. And, as the governor alluded to, I think right now at least, the Bank of Canada is more concerned about keeping that cost of living down sustainably going into the future. Right now, I think the bank is concerned about 2025 and 2026 and will probably try to get rates down if it can by that point in time in order to relieve at least some pressure on mortgage holders. But I think the stability report and the fact that the press conference chose to stress so much of the different strains being held by renters compared with that of mortgage holders shows that the bank is not so much in the mood to help the real estate industry right now. It's far more concerned with keeping inflation sustainably down.
It's not always about you, Stu.
And that's all going to be largely dependent on how Canada's inflation continues to come in over the next few months. We will have an update out on the May 21st inflation update on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.